How do you make capital investment decisions? We're going to get to some of these equations by thinking about a particular farmer's problem. This is George and Will, and they have a small farm. We're going to help them make these decisions. First, the people who have ideas and do things are not necessarily the same people who have the savings, who have the money. And so, for the past 500 years, we've invented a sophisticated financial system to help solve that problem. Those with resources deposit their cash in a bank, while those with the ideas and the ability to carry it out take out loans from the bank. The bank's job is to be the intermediary. They try to get the best returns for the savers. They help allocate our scarce savings to the most productive possibilities. At least that's the job. They don't always do it, and we're constantly trying to find ways to improve the system. Well, at least some people are. So, Will and George have to go to a bank, and they have to take into account interest rates over time. How can they measure the expected returns of future earnings? We need to talk about the idea of compounding and discounting. Compounding interest means deposits grow. So one problem George has is how much to save for Will's college. Over time, the initial deposit will grow due to the compounding nature of interest. We even have a formula for it. The value in some future period t is equal to the present value, which was deposited today, multiplied by the annual interest rate, raised to the t, the number of years we hold on to this deposit. Note that for mechanical purposes, the interest rate r is going to be in decimal form, so a 3% interest rate will be noted as 0.03. And this thing's pretty amazing, y'all. Exponential growth over time. Let's run through a few quick problems. The initial deposit is going to be $10,000. The prevailing interest rate is a nice clean 10%. How much of a return will they get after 1 year? We plug in the formula. It's just 1 year. 10% of $10,000 is $1,000. 1,000 plus 10,000 equals 11,000. But the next year, the interest applies to the entire 11,000, not just the original 10. And then you earn an additional 10% return off of the 11,000. We raise it by 1 because this is just applying to this 1 year, the second year, and we get 12,000. Plug in that 12,100. And now it continues to grow. But I want us to notice something. We can derive this original formula pretty easily. Let's collapse all these years into one. Notice the equation for year 3 is dependent upon what was happening in the previous years. I'm going to bring year 3 over here, but notice that 12,100 is simply equal to the 11,000 multiplied by the compounded interest rate. And same thing again, we know that the 11,000 is simply equal to the 10,000 multiplied by the compounded interest rate. And here we can do some simplification. We can combine all of these compounded interest rates. We know from our exponent rules that we can simply add up the exponents as long as the individual things are the same. In this case, 1 plus 0.1. We have 3 of them, and there you go. The future value in year 3 is simply equal to the present value of the initial deposit multiplied by the interest rate, all raised to 3, the 3 years that we're holding on to this. Now, not everybody walks through life with a formula memorized, and so there's lots of calculators out there on the internet. Just a real quick Google search for compound interest calculator. Here we have investor.of from the U.S. Securities and Exchange Commission, or the SEC, and we'll get the same number, $10,000. 3 years. Interest rate was 10%. It's an annual interest rate. Hit that calculating button, and we see the $13,300. Knowing how much something will grow over time will help us choose between different investment options. The timeline of importance is Will go to college in 10 years. If your name's Will, I want to know how often in your life you saw the sentence will do something. Which of the following investments should George, the father, choose to help prepare for this? The scenario we have in mind is that George earned an extra $15,000 at the end of a harvest. The first option is a certificate of deposit. The interest rate is 6%, and the terms are over 8 years. Another one is we could buy a 10-year government bond. Interest rate's 4%. Which one will yield a higher return? We need to plug these both into our future value formula, and we find some similar numbers, but even though the time horizon is shorter, the higher interest rate yields off, and the certificate of deposit is the best option, yielding $23,900. Now here's the deal. George is afraid that that $15,000 deposit might not be enough to pay for his son's education. So to go from a future number, a future goal, and find out how much we have to deposit presently, we need to use discounting, the opposite of compounding. It's basically the same formula, but we're going to rearrange it. So here's that formula. Future value is equal to present value multiplied by that compounding interest bit. George has an idea for how much college will be. In order to know how much we need today, we need to solve for the present value. And we get that simply by dividing both sides. George estimates university will cost $35,000. The prevailing interest rate is 6%. In that 8-year investment vehicle we chose, 1 plus the interest rate, raised over that 8-year certificate of deposit, means he would need to deposit nearly $22,000 today, which is around $7,000 more than the initial $15,000. These calculations help George prepare for the future. That $15,000 deposit won't be enough to pay for college. He'll have to make future deposits from future earnings as well. The manner by which we save for the future needs to incorporate an opportunity cost. There are many different options to invest in. We can put our savings in the stock market. We could put our savings in bonds. We could build a new thing, such as starting a business or expanding our current endeavors. Therefore, any equation equation about the future needs to take into account this opportunity cost. What was the next best thing you could have gotten from your savings? Which road will you take? When does a firm or a person decide to build something new? George has been offered a used tractor for that $15,000, and he knows this is a good enough piece of equipment it will yield an additional $2,000 each year. Is this a better return? We need more information, because here's the thing about the tractor. It breaks down. We're anticipating that the net revenue from the tractor is going to depreciate 5% each year. For each additional year, the tractor is going to require more and more maintenance. The depreciation can be in the explicit form of parts and labor for maintenance, but it also can be in the lost time working if the tractor is being maintained rather than functioning. So, should he take the offer? This problem's a little more difficult. We're going to initially need a spreadsheet. That initial investment is $15,000. We estimate that the depreciation rate is 5% a year, and the prevailing interest rate representing his opportunity cost is 6% a year. In that initial year, he doesn't earn any revenues, but the next year after harvest, he earns $2,000 in net. To figure out what the revenues will be the following year, we need to take into account that depreciation. We take the previous year's revenues and multiply it by 1 minus the depreciation rate, meaning in year 2 we will earn 95% of the revenues we earned in year 1, leaves us with $1,900. But we're not done. Money in the future is not as valuable as money today, so we need to take into account the opportunity cost. We take that $2,000 and discount it by the compounded interest component, 1 plus the interest rate of 0.6. In this case, it's the first year, so the exponent is equal to 1. And in present value terms, that $2,000 earned next year is the equivalent of $1,800 earned today. We can do the same exercise for the next year, and we see that that $1,900 is discounted using that interest rate of 6%. Now the exponent is raised to a 2 for a present value of $1,690. Do this exercise for years and years over the lifetime of the tractor, what the present value of future revenues will be. To make the decision of whether or not to buy it, we need to add up all of the net present value of the future stream of revenues, and we get $18,220. Considering today we're spending $15,000, and in the future we're expecting $18,000 again in today's dollars, time to buy that tractor. But notice it's not enough simply to earn a profit. You have to earn a profit over and above what you otherwise could earn simply putting the savings into the financial sector. Now, calculating the present value of all those future revenues doesn't necessarily require a spreadsheet. We can do some math and rearrange the whole thing down to a simple formula highlighted down at the bottom. Pause the screen if you really want to look through the math. If not, just skip it. But this is the formula to know. It's the first year's revenue divided by the prevailing interest rate plus the discount rate. We determine whether or not to invest in something if the present value of all future payments is at least as big as the total current cost. This is the rational rule. The benefit has to be at least as big as the cost. These calculations help us to understand big decisions across the world. For instance, why did George Lucas sell Star Wars? In 2012, the Walt Disney Company purchased Lucasfilm, owned by George himself, for $4.5 billion. George and his accountant were looking at the math, and they decided that the present value of all future revenues for himself was going to be less than that $4.5 billion. Number one, at the time he was 69 years old. He knew it would take another decade to create a sequel, let alone any other films. He wanted to spend more time with his family, so his personal opportunity cost was getting very high. Likewise, you can think about the future revenue. Perhaps if he created the films by himself, he wouldn't be able to earn the same levels of revenue on his own. Well, why did Disney buy Star Wars then? Don't they take the present value of all future revenues into account as well? True, but from their side, their present value of all future revenues were calculated to be above $4.5 billion. Number one, George Lucas, like all humans, will eventually pass away. However, Disney as a corporation can potentially live forever. Lucas said in a statement, "I've always believed that Star Wars could live beyond me, and I thought it was important to set up a transition during my lifetime." And has Disney seen a return on their revenue? By 2015, they already garnered $5 to $7 billion in merchandise revenue alone. And it's not just Star Wars. A legendary musician, Bruce Springsteen, sells his publishing catalog to Sony for $500 million. Literature Nobel laureate Bob Dylan sold his entire catalog for between $150 and $200 million. And it's not just legacy acts. Katy Perry recently sold her catalog for over $200 million. The calculations everybody's keeping in mind are the next year's revenue divided by the sum of their opportunity cost interest rate plus the depreciation rate. These formulas are worth knowing. They help allocate trillions of dollars of long-run assets and investment across the globe.